Barry comes
Fantastic.
back and he says, I refied about 5 years ago, 302,000, 3.5% interest. I currently owe 229,000 at the same 3.5% as of today. He further commented, my taxes and insurance are included, but I've learned from you recently that it's best to pay those separately and don't incorporate into the mortgage. Thank you. So he has shared his information, but he also shared a word of thanks as well. So Don, here's the details.
All right, folks, here we go. We've got on the screen 302,000 at 3.5. The principal and interest payment is $1,356.11. So right now we're down to $229,000 approximately. So he says he's been in the loan about 5 years. I haven't looked at this yet, so I'm going to look at and see where we are at $229,000. So we're going to go down to 229,000. Watch this. 229,000. That puts us right about here. Okay. Now, this tells me one thing. We are at 120 months. Okay. 120 months. That's 10 years in. So what he's been doing is he's been putting some extra money into this loan already. All right. And so he is all the way down here already in 5 years. Okay. So he's got the same amount of equity right here. So look at this. He's down to 229,000. So he's paid 72,000 towards the principal already. If he had done this the bank's way, the bank would have charged him $99,000 in interest to get here. So he's already saved quite a bit of money already. And he says, now, so here's what I'm trying to tell you right now, Barry. What most people don't realize is when they make an extra payment, how much interest are they saving per dollar applied? And here's what I want to point out to you. I'm going to go back up here and point out one thing. Not only do we want to save interest, but we want to save the maximum amount of interest per dollar. I can tell you right now, we can figure out how much interest you still owe on this loan, figure that out, and how you can be more strategic about paying this loan off and saving the maximum amount of interest per dollar. And I'm going to show you just one thing here. We're going to put a calculator on the screen. Okay. We're going to take a look at two numbers. We're going to take a line 12 and we're going to take a line 24. Anybody who has been into the rooms before, I'm going to look at prepaying. This is the principal payment for 12 months. Here's the interest payment for 12 months. Let's just say there's plenty of money in the bank and we could prepay this. If we prepay this at the beginning, we're paid down to line 12 in 1 month. We save a ton of interest and knock off payments because we're already here. Or we could do line 24, where we are prepaying $11,797.56 and knocking off this much. So here's the thing. When is more too much? In anything that we do, ladies and gentlemen, in anything that we do, there's a point at which more is too much. Okay? Whether you're putting a little salt on your food, whether you're putting jerk seasoning on your chicken, there's a point at which more is too much. If I can take 2 Tylenol and get rid of my headache in 20 minutes, whew, how fast could I get rid of my headache if I took 20 Tylenol? Somebody said permanently. So there's a point at which more is too much. So what we haven't been told is that we can violate the law of diminished return when paying off a loan as well, because we want to save the maximum amount of interest per dollar. So let me put that back on the screen. Let's just take a look at this. If I can save 10,000, we're looking at line 12. If I can save $10,477.61, all right, by prepaying $5,795.71, we're going to divide that by that number. Okay, $5,795.71. we're finding out that we could save $1.80, almost $1.81 per dollar applied. Okay, that's going to be very good. So in other words, if you gave me $1 and I gave you back $1.80, how many times would you do that? Well, folks, the bank has to do the very same thing. You give them $1 at this point, it makes it impossible for them to charge you $1.80 in interest because you did that. So here's where we are. So now let's take a look at line 24. So we're going to clear that out. Our savings now, we're looking at $20,749.08. Right? And now we're going to divide it by 11,797.56. And how much are we saving per dollar? $1.75, almost $1.76. So that's my point, folks. If we could save $1.80 per dollar, why would we ever save $1.75 per dollar? And it actually gets worse than that when we're putting a lot of money on at one time. So here's the point I'm trying to make, folks. Using a critical point analysis, finding that point at which more is too much. If you're into NASCAR, do you realize that every one of those cars is set up to run on that specific track that they're racing on that weekend? And they're setting it up so that they can take advantage of the bank on the track when they're doing the curves. So they know exactly how fast they can drive in the curve so that the car doesn't fly off the track. And they have to set up that car specifically for that curve. If they do it wrong and they go too fast, now the car cannot stay on the track. Centrifugal force will drive it off the track and they will crash. So here's what we're talking about, folks. When you're paying off these loans too fast, you will not save the maximum amount of interest per dollar. So here's what we want you to know. When we should stop putting money towards debt reduction and then take the difference and put it towards wealth creation. Don't get tunnel vision and say, let's throw all the money over here, or let's throw all the money over there. Know exactly how much you're working with, what your benefit is going to be. And then once you reach 100% of your benefit, you can't get better than that. Anything else, your benefit starts to go down. So here's what I want to tell you. Save what you can save. But remember this, monies that you could have earned in interest that you didn't earn should be considered a loss. Remember that. All right, so this is going to help us to understand that. Now, here's the other thing, Barry. Since you asked that question, let's take a look. Once you contact us, we're going to take a look at what you have in your loan right now, put it into the system, and then tell you how you can optimize your interest savings on what you have left on the loan to keep you from violating the law of diminished return and flying your car right off the track. I hope that's helpful.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.